All right, in today's video, we're going to be talking about mortgage rates, specifically why first-time home buyers are sometimes surprised by the higher mortgage rates that they're being quoted when they're seeing lower rates out there being advertised in the marketplace. In addition to that, we're going to talk about how that impacts affordability in the housing market and what a potential home buyer can do to avoid any surprises. So let's go ahead and jump right into it. The first thing I want to bring your attention to is this graph here with mortgage rates today. This is from Mortgage News Daily. They post a daily rate survey. This is actually a national average. Now they have several different products here, but for purposes of discussion, we're just going to talk about the conventional 30-year fixed rate mortgage, which on average is coming in at just over 7% as of today. Even though this is the rate that is advertised, it's based on a group of assumptions. So if you go over here in the fine print, so to speak, you can go ahead and click on this link that says learn about our rate survey. This is actually the rate index methodology, and this includes all of the assumptions that are utilized in order to calculate their pricing model here. There's several different factors, but what I want to do is point your attention to what I feel is the most important, and that's this right here. So what they're indicating here is that this is a top tier scenario, and they utilize this criteria as a baseline: 75 LTV and a 760 FICO. Now, LTV stands for loan to value. That's how much is owed on the property versus how much it's worth. Now, in a purchase transaction, this would mean that the borrower or home buyer would actually be putting 25% down in order to achieve that. And for many first-time home buyers out there, 25% down is not an option. In fact, I think the national average with down payments today is somewhere around like 8 or 9%. Now, 760 FICO, that has to do with credit score. Generally, lenders are going to do what we call a tri-merge report. So they pull from all three bureaus. That's going to be Experian, TransUnion, and Equifax. And the lender will qualify you based on the middle FICO score. So whatever that is what they'll utilize to help you qualify. Now, 760 is what we would consider an excellent score. And even though it is possible for a first-time homebuyer to have an excellent credit score just like this, I think the national average is somewhere around 698, so just under 700. And the point that I want to make by bringing this to your attention is that what's quoted online is oftentimes not always the rate quote that a borrower receives when they go to get a pre-approval. Now that I talked about how the national average is calculated, I want to talk about how mortgage companies often will advertise certain rates. And it works basically the same way. So I want to unpack that, and I want to demonstrate why this happens and how you can keep an eye out for it yourself. So I'm just on Wells Fargo's website. I literally just Googled Wells Fargo mortgage rates today to see where we're at. I clicked on purchase rates. That's what we're looking at here today for this example. And if you take a look, they list out several different products. But since we're talking about a 30-year fixed conventional right here, I want to go ahead and see what they're quoting. So interest rate, 6.625. That's actually 3/8 less than the national average that we're actually seeing. And then they have the APR here at 6.837. So the rate is actually pretty good. But the question is, what are the assumptions? So if you go ahead and actually click on this, it'll outline what the assumptions are. And this is something that you'll want to do as you're shopping around for a mortgage, or at least be mindful of, so that you can make an educated decision as you're making your forecasts and your projections when you're going to purchase a home there. So we have the 30-year fixed, we show the interest rate, we show the loan amount that they're using. Oh, look at this, down payment, 25%, just like the assumption used on the national average. The term's 30 years. And then you have the monthly payment, and you can see that this actually excludes taxes and insurance. So the total payment will be higher than what's actually quoted here. Then it shows the closing costs, and it says that it includes the cost for required discount points. Now I want to touch on this real quick because they talk about discount points. This can be somewhat deceiving. I don't know if that's the right word for it or not, but discount makes it seem like you're actually getting a better deal. That's not the case. It's really the cost in which it takes to purchase that rate. So generally, if you're paying discount points, it means you're paying an additional cost to secure that rate. And if you look up here in the actual writing, it says today's purchase rates are based on a purchase of a single family home. It's a primary residence, and it's located in the state of Texas. So all of this can change depending on where you are throughout the country. Now, this rate assumes a credit score of 740 or higher. It includes 1% in discount points. So that's a percentage based on the loan size. Okay, this loan amount here is $200,000, which means a 1% discount point is actually going to be $2,000. This is very common between lenders. In fact, here is the rates as of August 3rd today for a local credit union here in the California market. And if we scroll down, we can see the 30-year fixed. The rate they're quoting 7.25% with a quarter-point discount. That's an additional cost associated with securing that rate. And if you click on the link, you can see their assumptions here. So we have a $300,000 loan, $400,000 property value. So it means they have a 25% down payment in this particular case. And their credit score is 740. So you can kind of see this trend starting to unfold. Now, I also went ahead and searched the average mortgage rates in Google. We did a $400,000 loan. We did 5% down, which is probably more typical for a first-time home buyer. And then if we look at the average credit score throughout the United States, which is somewhere between 680 and 699, you can see that the average 30-year fixed mortgage rate is somewhere around 7.7%. Now, this is more likely than not the par cost, meaning there's no additional discount points associated with securing that rate. And if you go over to a mortgage calculator, let's say you can get 6.625% with a bit of a cost in one of those top tier scenarios, $400,000 loan amount, payment's going to be $2,561. Well, if instead you go out and you're able to get, let's say, 7.25, now we're going to be looking at a payment of about $27.29, and that's roughly $150, $160 a month difference. So it really can impact housing affordability, and it can really surprise first-time homebuyers. Now, with that said, I want to be really clear. This is not meant to scare anyone. This is just meant to shed a little bit of light on how mortgage rates are actually calculated. And I really want to drive the point home that the best way to potentially avoid surprises like this is to consider connecting with a good mortgage banker or mortgage broker up front so that they can run your full scenario, do a full pre-approval, verify where credit is, verify where income is, verify where assets are, and then work up your actual scenario so they can deliver at least an estimate of where your mortgage rates will be at that time. Now, mortgage rates change every single day, and until you actually secure a property, the rate will basically be floating, meaning it can fluctuate. Anyway, that is going to wrap it up for today's video. I hope you found this information useful. If you're new to the channel, I would be so grateful if you liked, subscribed. Feel free to leave comments below. We'll see you next time. Take care.